In 2026, more than $1.5 trillion in commercial loans will come due and must be refinanced at interest rates dramatically higher than the last decade. That number is not internet drama. That number is not a thumbnail exaggeration. That number is a structural reality embedded inside the financial calendar of global credit. And people do not understand what that means yet. They think debt rollover is just a contract renewal. They think it is just paperwork. They think it is just a bank process. They do not realize that refinancing at a higher cost is equal to a new business model. If the old business model cannot sustain the new interest cost, then the business model breaks. And this is why 2026 is not a joke number. It is a pressure point. It is the year where assumptions collide with reality. Subscribe to finance truths. People always expect a crisis to look dramatic from the beginning. They wait for red headlines. They wait for chaos charts going viral. They wait for panic on screens. But real financial damage rarely starts loudly. Real damage begins when conditions quietly change and people continue behaving as if nothing changed. This is exactly where the world is right now. The conditions have changed, but the behavior of people has not caught up with that change. The world spent more than a decade living inside a distorted environment where money was nearly free. When money is cheap enough for long enough, it becomes invisible. People stopped thinking about cost of capital. People stopped thinking about refinancing risk. People stopped thinking about debt sustainability. High leverage becomes normal. Rolling over loans becomes instinct, not strategy. Risk does not feel like risk anymore because nothing punishes it. Then, slowly, the cost of money rises. But psychology stays stuck in the old world. This is one of the most dangerous behavioral lags in macro cycles. People continue to make decisions as if money is cheap long after money becomes expensive. They believe cuts are coming any minute. They believe policymakers will come to the rescue. They believe someone will bring back the easy liquidity. They believe the old world will return. This type of denial has existed before. History has seen different cycles, different catalysts, different triggers, but one repeating pattern. Humans delay updating their behavior. Humans hate accepting that the environment has permanently changed. They prefer believing that conditions will revert back to comfort. Comfort always feels like the baseline. Pain always feels temporary. But sometimes pain is not temporary. Sometimes pain is the new baseline. Before continuing, a conceptual transition is needed. The real danger of 2026 is not the interest rate itself. The real danger is the collision between structural inflation, slow policy flexibility, global fragmentation, and refinancing cycles. None of these forces individually create collapse. But when they converge at the same time window, they distort incentives. And when incentives distort, decision makers behave irrationally. They try to delay restructuring. They try to delay recognition of losses. They try to maintain old leverage levels. And delay always increases the eventual damage. This is where the world stands today, a delayed recognition environment. People think that because markets are not exploding, then risks are exaggerated. They forget that credit cycles rarely explode in the beginning. They decay quietly and then break suddenly. The breaking point is not a single event. The breaking point is the moment when refinancing reveals who cannot carry the new cost of money. The 2026 maturity wall is not a theory. It is not a prediction. It is a date structure. Debt maturities are scheduled. They do not respond to mood. They do not respond to Twitter sentiment. They do not respond to hope. Debt is time-based, and time is not negotiable. When the rollover date arrives, the rate is the rate. There's no opinion at that moment. There's no hope at that moment. There's only math. This is what most people still don't understand. The future is not waiting for their beliefs. The future is waiting for the calendar. When the refinancing window opens, the structure of the system is revealed. The system always tolerates stress when money is cheap. The system only reveals truth when money becomes expensive. Humans do not emotionally process this well. They think the system is stable because nothing bad is happening this second. They think danger is only real if it is visible immediately. They don't understand that structural danger accumulates invisibly long before it becomes visible. The majority of economic damage in life does not happen at the top of the wave. It happens while the wave is forming. When the wave hits, people blame the crash, but the crash was just the final domino. The true destruction was already locked in through decisions made months or years earlier. This is how human psychology misprices risk. People react to events, not to incentives. But incentives decide events. This is why inflation matters. Inflation is an incentive distortion. When the price baseline is unstable, then policy becomes reactive. When policy becomes reactive, then forward planning becomes fragile. And when forward planning becomes fragile, then the future cost of debt becomes unpredictable. The unknown future price of money is the single most destabilizing psychological factor in finance. People can accept high rates if they know how long the high rates last. People panic when they cannot map the future cost of capital. Now combine this with geopolitical fragmentation. For decades, the global machine was built around one idea: efficiency. Efficiency meant lower costs. Lower costs meant lower inflation. Lower inflation allowed cheap capital. Cheap capital allowed high leverage. High leverage created high growth illusions. Fragmentation reverses all of that. Fragmentation is not a war event. Fragmentation is a structural shift in strategy. Nations want control over their own supply chains again. Nations want control over critical materials again. Nations want strategic independence again. Strategic independence is expensive. Expensive strategy increases structural inflation. And structural inflation forces interest rates into territory that requires higher baseline. This is how geopolitics connects to refinancing pressure. It is not emotional. It is mechanical. Now, the final piece of this conceptual foundation is how humans react to slow pressure. Humans normalize slow damage. Humans ignore slow tightening. Humans underestimate slow erosion. If a system collapses instantly, everyone understands there is a problem. If a system tightens gradually, almost no one understands what is happening until the break. This is why 2026 is not a prediction year. It is a revelation year. It is the year when free money era assumptions collide with expensive money era conditions. And people who continue to believe the old regime will return will experience the sharpest shock. This is the invisible moment that always precedes visible crisis, when the majority still believes that nothing truly changed. People are not scared enough, not because conditions are safe, but because conditions are slow. The quiet phase is the most dangerous phase. The structural adjustment has already begun. People just have not emotionally accepted it yet. This is the point where most people underestimate reality. They still think the stress is theoretical. They still think the stress is negotiable. They still think the stress is temporary. But history shows that the most dangerous moment in every credit cycle is not the blow-up moment. It is the denial moment right before it. The world is not collapsing. The world is quietly repricing what money costs. And the repricing of money always reveals who built their success on fundamentals, and who survived only because credit used to be free. People rarely remember the quiet part of history. They remember the dramatic chapter. They remember the headlines. They remember the day everything broke. But they do not remember the years of slow pressure before the break. And that is why they misinterpret the present. They believe that because nothing catastrophic is happening right now, that nothing catastrophic is building. They confuse silence for stability. But silence, historically, is often the sound of pressure accumulating underneath. This is why the cycles of financial history are the only real teacher, because the cycles expose how humans misunderstand time. Time in financial systems is not emotional time. It is mechanical time. Capital does not care about sentiment. Debt does not care about mood. Refinancing dates do not care about confidence. The calendar always arrives, and when the calendar arrives under a new capital cost regime, the truth inside the system becomes visible instantly. History shows this pattern repeatedly. In the late 1920s, people believed prosperity would last forever. In the mid-1970s, people believed inflation was a temporary shock. In the late 1980s, people believed commercial real estate would always go up. In the late 1990s, people believed earnings did not matter. In 2006, people believed housing always recovers. In 2020, people believed unlimited stimulus had no long-term cost. Each time, the belief system was a coping mechanism that delayed acceptance. And each time, the delayed acceptance made the eventual recognition more violent. Because the truth is this: the cracks always show up first in refinancing. When the cost of debt changes, the true strength of cash flow is revealed. The present era is not being shaped by panic. The present era is being shaped by mispricing. People still believe that we are inside temporary turbulence that will magically normalize back to a low-rate world. That belief is not based on analysis. That belief is based on comfort addiction. But the incentives have changed. This is where structural inflation becomes a pivotal piece of the transformation. Structural inflation is not caused by consumer excitement. Structural inflation is caused by cost structure change. When supply chains are reorganized, when production is reshored, when strategic independence is prioritized, when the world's geopolitical map becomes more expensive to maintain, inflation becomes sticky. Sticky inflation is the enemy of fast rate cuts. Fast rate cuts require inflation to behave. But when inflation has structural drivers, central banks must stay cautious longer, even if growth cools. This is the paradox the majority does not grasp yet. The world can enter a slowing growth environment while rates remain high. In the past generation, people got used to a simple rule: slow down, occur under rate cuts. That rule is broken. This creates a trap in 2026. If growth slows while the cost of money stays high, refinancing becomes the mechanism that filters the strong from the weak. The weak cannot roll their debt at sustainable cost. They break. People always assume the first cracks will appear in public markets. That is not where cracks appear. The cracks appear in private capital first. The cracks appear in commercial real estate first. The cracks appear in small, mid-sized corporate debt portfolios first. The cracks appear where transparency is lowest and acknowledgement is slowest. History proves this. Crisis never announces itself through the front door of the stock market. Crisis begins in obscure corners of balance sheets that most people are not monitoring. People forget that the U.S. savings and loan collapse in the late 80s did not begin in Wall Street pricing. It began in localized commercial lending portfolios that were assumed safe until refinancing exposed they weren't. People forget that the dot-com bust did not begin when the NASDAQ fell. It began when companies quietly failed to raise new rounds. People forget the global financial crisis did not begin when Lehman collapsed. It began when subprime mortgage resets started quietly breaking payment capacity long before headlines existed. History doesn't repeat. History exposes patterns of human blindness. Today's blindness is located in the assumption that rates will go back down soon. That one belief is the most dangerous belief in financial psychology right now, because that belief is the operating assumption underwriting trillions of future refinancing expectations. But the world changed structure. Inflation is no longer primarily demand-based. It is supply chain-based. It is geopolitical-based. It is resource-based. It is strategic security-based. These categories do not disappear simply because markets want comfort again. These categories define elevated baseline cost. The world now lives in an economy where the cost of money is structurally higher because the world itself has structurally shifted. Humans are still mentally living in the previous decade. The system is already living in the next one. This is the most dangerous configuration in all of macroeconomics, when people price the future based on the past after the past has died. In 2026, the calendar will force recognition. Not because someone predicts it, not because someone wants panic, but because refinancing forces math, and math forces reality. Humans accept illusions until illusions become unaffordable. Then illusions evaporate instantly. This is the stage where denial turns to shock. This is the stage where structural change becomes undeniable. This is the stage where the free money era finally leaves the human mind, not by persuasion, but by force. There comes a moment in every long economic transition when people finally recognize that the old world is gone. Not because someone explained it, not because someone convinced them, but because the new incentives become too strong to ignore. In finance, incentives always win. If refinancing becomes too expensive, people will stop believing the old rate world will return. If structural inflation refuses to collapse, people will stop pretending that this is just a temporary distortion. If geopolitical fragmentation continues, people will stop expecting cheap global efficiency to magically return. Human belief is powerful, but belief cannot survive mathematical reality forever. This is the silent hinge point that separates temporary turbulence from structural transformation. Humans accept permanent change only at the moment where denial becomes too costly. The current period is extremely similar to that stage in history, not identical, but uncomfortably close. People in the late 1920s expected the boom to continue. People in the mid-1970s expected inflation to revert automatically. People in the late 1980s expected commercial property to remain a safe store of value. People in the late 1990s expected earnings to be optional. People in 2006 expected risk to be infinitely transferable. People in 2020 expected stimulus to have no future consequences. Every era has a dominant comfort belief that makes the present feel secure. The dominant comfort belief today is this: rates will go back down. That is the sentence that is holding together billions of dollars of psychological stability. That is the sentence that is preventing revaluation of assets. That is the sentence that is postponing the recognition of stress. That is the sentence that keeps people behaving as if the old world is still here. But structural inflation, geopolitical independence, supply chain regionalization, energy transition, and demographic shifts are not temporary anomalies. These forces are the architecture of the new world. They require elevated capital cost. They require higher baseline rates. They require more expensive funding structures. People don't update because they don't want to update. They want to be right about yesterday. They want the world to return to the version that rewarded their past decisions. People are emotionally attached to the world that benefited them, but the world that benefited them may be gone. This is why 2026 carries so much psychological weight. 2026 is not just a maturity wall date. 2026 is the first large-scale mandatory confrontation with the cost of money. When refinancing becomes unavoidable at scale, belief collapses and reality takes over. And reality is not emotional. Reality is not nostalgic. Reality is a balance sheet. Reality is a cash flow statement. Reality is an underwriting model. Reality is solvency. Humans cling to sentiment. Markets are governed by solvency. History proves that collapse narratives are often wrong, but solvency mathematics is almost never wrong. Human fear can exaggerate, human confidence can deny, but interest expense is not emotional. It is a fixed line item. This is the true mechanism behind every major dislocation. when the cost of money moves faster than the belief system of the people who borrowed it. This is why people continue behaving like the old world is still alive. They do not want to accept that the cost of leverage is now a governor, not a lubricant. For more than a decade, leverage accelerated rewards. In the new environment, leverage accelerates exposure. And people do not recalibrate instantly. They cling to the dopamine of the past. They cling to the logic that made them feel intelligent. They cling to the conditions that made their decisions correct. The longer they cling, the more brutal the break. When the break arrives, people always rewrite the story backwards. They say the signs were obvious. They say the signals were everywhere. They say they knew something was off, but what they actually knew was that the comfort narrative felt good. The danger narrative felt uncomfortable. Humans choose comfort until comfort becomes impossible. Then they call the moment of reckoning a surprise. The truth is not dramatic. The truth is simple. The world is shifting from a cheap money equilibrium to an expensive money equilibrium. Equilibriums do not care about preference. They do not care about desire. They do not care about nostalgia. They care about structure. And the structure of global capital has already shifted. This next stage is not a question of whether people like the new world. The question is whether they will survive it. Every historic cycle ends with the same emotional sentence, "Well, we didn't think it would actually matter this much." That sentence, more than any headline, marks the moment where denial ends and recognition arrives. That sentence is the emotional obituary of every outdated belief system. The people who survive the new world are the people who accept reality early. The people who get destroyed are the people who wait for the old world to return. The world is not collapsing. The world is resetting. A reset is not destruction. A reset is a recalibration of truth. The price of money is the ultimate truth. The price of money is the scoreboard. The price of money is the referee that exposes who built something that can stand on its own, and who built something that only worked when capital was free. This is the real meaning of 2026. Not apocalypse, not fear, not doom. Revelation. 2026 is the year where free money illusions expire. And illusions only die one way, instantly. Not because people choose to kill them, but because the calendar kills them.